Something just happened in December 2024. It's one of those things that, if you're just watching the regular news, you probably missed it. But for a bank like JPMorgan Chase, this was the nightmare scenario. It's the exact thing they have spent the last 15 years trying to make sure never, ever happens. So what was it? Well, they got hit with delivery notices, and I'm not talking about a small amount here. We are talking about notices for 52 million ounces of actual physical silver. Now, usually, in the futures market, you can just roll those contracts over to the next month, or you can settle them with cash. That's how the game is played. But this time, they couldn't roll them. They couldn't just pay people off with cash. And they certainly couldn't just ignore it. See? This. This wasn't supposed to happen. It's the whole silver market on the COMEX, that S. The exchange where all this trading happens is built on one really big, really important assumption. And that assumption is that you, the trader, will always take the cash instead of the heavy bars of metal. That's the glue holding the whole thing together. But the moment silver hit $59 an ounce, that assumption basically died. And now JP Morgan is staring down the barrel of a trap that, ironically, they built for themselves. Let's just step back for a second. Think about how these futures contracts are supposed to work. Most of us, regular folks, we look at these financial markets and we think, okay, that's where commodities are bought and sold, right? Like, if you buy wheat futures, you're buying wheat. But here is the thing that should really grab your attention. If you look at the actual data from COMEX historically, 95% of all silver contracts never touch a single ounce of metal. They settle in cash, 95%. Think about that math. That means for every 100 contracts where someone promises to deliver silver, only 5 people actually show up and say, hey, put the bars in my truck. The other 95 people, they just take their profit, or they take their loss in dollars and they walk away. Now, this creates a situation that is incredibly convenient for the banks running the show. I mean, think about it. You know statistically that only 5 guys out of 100 are going to ask for the real stuff. Then theoretically, you can sell 100 paper promises backed by just 5 ounces of silver sitting in a vault. It's fractional reserve banking, but applied to precious metals. You promise delivery to everybody, knowing full well that almost nobody is going to call your bluff. And you know what? For decades, this system worked like a charm. It worked perfectly because that assumption that people want cash, not metal, held true. But here's where JP Morgan enters the picture. They didn't just participate in this system, they dominated it. If you look at the period between 2010 and 2020, they positioned themselves as the absolute biggest vault operator on the COMEX exchange. You have to ask yourself, why? Why would the biggest bank in America want to be in the business of running warehousing for silver bars? It's heavy, it takes up space, ... It seems boring, but the reason is simple. Controlling the vaults meant they controlled the delivery process. So on those rare occasions when someone actually stood up and demanded physical metal, JP Morgan could just handle it internally. They could shuffle inventory between their eligible category and their registered category. It's a shell game. They could create the appearance that there was plenty of supply without actually having. To go out into the open market and buy new metal, it kept the price nice and calm. But then the story gets interesting. In June 2021, the rules of the game changed. And I bet most people never even heard about this. It happened in the global banking system with something called the Basel III International Banking Regulations. These rules went into effect across Europe first, and then they started phasing into our markets over the next few years. Now, buried deep in these boring regulatory updates was a change in technical classification. It sounds super dry, I know, but once you understand what it does, it's explosive. See, there's this thing called unallocated precious metals. That's just a fancy term for a paper claim on metal that is specifically set aside for you. It's a generic promise. Well, Basel III took those unallocated claims and reclassified them. They went from being Tier 1 assets down to Tier 3 assets. What does that mean in plain English? It means banks can no longer count those paper promises as high-quality assets on their balance sheets. If you are holding a position that promises silver delivery, you can't just have a paper contract anymore. You now need to back it with actual physical metal. You can't just use another paper contract to back your paper contract. Basically, the international banking laws shut down the fractional reserve game. There were no press conferences, no big dramatic speeches. It was just a footnote in a regulatory book. But that footnote made the old strategy, the manipulation strategy, mathematically impossible to keep up. So you might be wondering, okay, but why does this matter right now? Specifically, why is $59 per ounce the magic number? Well, pop quiz. Okay. What happens when silver crosses a certain price? It changes the fundamental economics of who is buying and who is selling. When the price hit $58.50, we saw something shift in the mining industry. At that price, silver production becomes profitable enough that the big producers companies like First Majestic Silver and Pan American Silver started making a calculated decision. Instead of just dumping their newly mined silver into the COMEX warehouses at whatever price the exchange offered, they stopped. They began selling directly to industrial buyers. And they were selling at premium prices. It makes sense, doesn't it? Why would you feed the exchange, the very place that has been keeping the value of your product down for years? When there are manufacturers out there willing to pay you more for a guaranteed supply, then, there is the China factor. This is something most American investors just don't fully appreciate. You have the Shanghai Gold Exchange. That is where physical metal actually trades in Asia. In November, the price of silver in Shanghai hit the equivalent of $62. So, do the math. You have silver sitting in COMEX warehouses at $1.59. You have buyers in Shanghai willing to pay $1.62. That created what traders call an arbitrage opportunity. It's free money. If you buy it here for $59, ship it there and sell it for $62. It's simple geography and mathematics. But the consequence of that? COMEX inventory dropped like a rock. We saw 41 million ounces leave the inventory in November alone, just flowing east to capture that price spread. But frankly, the real pressure at $59 isn't coming from traders or miners. It's coming from an entirely different category of buyer, the industrial users. We are talking about the people who make solar panels, the electronics companies, the electric vehicle producers. These guys need silver to actually make things. They aren't speculating on the price. They need it for production. These companies have supply chain managers. Their whole job is to make sure they have the materials for their 2025 manufacturing contracts. And let me tell you, when silver crosses $59, it triggers something pretty close to panic in those procurement departments. Because that price level signals that there might be a shortage ahead, put yourself in their shoes for a second. Imagine you are responsible for finding 10 million ounces of silver for your company's solar panel line next year. Your entire schedule, your jobs, your revenue, it all depends on that material arriving on time. At $58, maybe you wait. Maybe you hope the price dips a little. But at $59, you stop hoping. You start panic buying. Because the cost of missing your production targets is way, way higher than the cost of paying a premium for the metal. These industrial buyers are the ones who actually need physical delivery. They just removed themselves from the game. They aren't going to be the exit liquidity that paper traders usually rely on. They are keeping the metal. So here is the trap that JPMorgan built for themselves. It's pure math, and there are no escape routes. According to the data from the CFTC commitment of traders between 2008 and 2020, they accumulated 947 million ounces of paper short positions. That is nearly 1 billion ounces of promises to deliver silver. The strategy was brilliant in its simplicity. You take the short side of the futures contracts, you collect the premiums, and you almost never have to actually deliver the metal because, remember, 95% of people settle in cash. You control the vaults, you control the game, and you repeat that for 15 years. But Basel III changed the equation. It required physical backing for those paper positions. Their vault inventory, which peaked at 47 million ounces in early 2023, has collapsed. It's down to just 89 million ounces today. Wait, that sounds weird, right? But the point is, they are seeing a massive depletion rate. And at $59 per ounce, the demands for delivery are accelerating. Why? Because all three pressure points are hitting them at the same time. You have mining supply withholding metal. You have the Asian arbitrage sucking metal out. And you have industrial panic buying. Every single ounce that JPMorgan delivers to satisfy one of those contracts depletes the physical inventory they have to back their remaining paper positions. And every ounce they refuse to deliver. Well, that just proves the market is fraudulent. It triggers even more demands from contract holders who suddenly realize the emperor has no clothes. They can't win, they can't get out. The clock is ticking loudly. Because if you look at registered inventory across all COMEX vaults, it just hit 28 million ounces. That is enough to cover just 84 days of demand at the current rates. Let me put this in perspective for you. Imagine you wrote 100 checks, promising to pay someone $1,000 each, but you only keep $5,000 in your bank account because, historically, only 5 people ever cash their checks. Everyone else just trades them back and forth like they are money. But then, the rules change. The bank tells you that you need actual money backing every check you wrote. And suddenly, people start showing up to cash those checks because they realize you might not be good for it. How long before your account is empty? How long before you are facing bounced check fees? That is JPMorgan's situation right now. Except we aren't talking about a few $1,000s. You're talking about billions of dollars and a commodity that the entire modern economy depends on. Now, look, I know what you're thinking. Sounds like another conspiracy theory about big banks manipulating markets, right? Except this time, we have the receipts. And not just any receipts. We have official government data, regulatory settlement documents, and JPMorgan's own SEC filings. The story is so clear that even the people doing the manipulation couldn't hide it. Let's start with the CFTC Commitment of Traders reports. These are public documents released every week. Think of it as a scoreboard showing who is betting up and who is betting down. For over a decade, these reports showed something that should have set off alarm bells at every regulatory agency in the country: JPMorgan. Chase held a concentrated short position, averaging 32% of the entire COMEX silver market between 2010 and 2024. Let me repeat that. One single bank controlled nearly 1/3 of all short positions in the American silver market. In March 2020, their position peaked at 40,550 contracts. That represents 202 million ounces of silver they promised to deliver. To put that in perspective, that is more silver than most mining companies produce in 5 years. Here is where it gets really wild. The CFTC has position limit rules designed specifically to stop this. The limit for silver is supposed to be 9,000 contracts. So how did JPMorgan hold over 40,000 contracts, 4.5 times the legal limit? They claimed an exemption. According to their filings, all those short positions were hedging for their vault operations. Think about what that means. You are allowed to break the rules if you claim you are hedging legitimate business risk. But if you run the vault specifically to help you manipulate the market, and then use the vault as the excuse for your unlimited position size, you have created a perfectly circular scheme. It's like owning a casino, loading the dice, and then claiming your gambling is just hedging your casino business risk. Regulators bought this excuse for 14 years. But the evidence didn't stay hidden. In September 2020, JPMorgan agreed to pay $920 million to settle charges with the Department of Justice and the CFTC. The charge was spoofing. That's placing fake orders to move prices and then canceling them. According to the investigation, their traders placed thousands of these spoofing orders between 2008 and 2016. They were creating false impressions of supply and demand to move prices in their favor. $920 million. That is the largest precious metals manipulation fine in American history. And here's the part that makes you angry. JPMorgan didn't have to admit wrongdoing. They paid the fine, said they would improve controls, and kept their massive short position completely intact. The underlying manipulation was never addressed. They paid it like it was just a cost of doing business. But look at the CFTC data from November 2024. It tells you why this matters now. For the first time since 2008, JPMorgan's silver short position dropped below 15,000 contracts. That's not because they decided to be nice and stop their winning strategy. It's because they are being forced to deliver physical metal to satisfy contracts. Each delivery is a forced closure of their position. They can't paper over it anymore. The scheme worked for 14 years because the paper game never had to become a physical game. But at $59 an ounce with Basel III enforcement, the physical game is the only game left. If you want to understand where this is heading, you have to look at the last time someone tried to corner the silver market. March 1980, the Hunt brothers. Bunker and Herbert Hunt accumulated 59 million ounces of physical silver between 1973 and 1980. They drove the price from $6 all the way up to $49.45. Adjusted for inflation, that is like $187 in today's money. Their strategy was simple: buy futures, demand delivery, and squeeze the shorts. By early 1980, COMEX was in a crisis. They didn't have enough metal. The whole market was about to collapse. So what did COMEX do? They did what regulators always do when the powerful are losing. They changed the rules mid-game. On January 21, 1980, they implemented Silver Rule 7. This banned any new long-only positions you could only sell, couldn't buy. The purpose was to crush the Hunt brothers. And it worked. Silver crashed from $49 to below $11 in 4 months. The Hunt brothers went bankrupt. The short sellers were saved. The lesson was clear. You can't beat the exchange because the exchange will cheat to protect itself. But fast forward to today. The situation has one critical difference. The current delivery pressure involves 862 million ounces of open interest. That is 14 times larger than what the Hunt brothers had. But here is the trap for the regulators. They can't just implement Silver Rule 7 again. Why? Because Basel III supersedes COMEX bylaws. Basel III is international banking law. It's not some rule a committee can vote to suspend. JPMorgan can't lobby it away. Violating Basel III means violating global compliance standards. Plus, the Hunt brothers were just one family. Today's pressure comes from industrial users who need the metal for production. It comes from sovereign wealth funds. It comes from thousands of retail investors. You can bankrupt one billionaire family. You cannot bankrupt the entire industrial supply chain without collapsing the economy. But if you want the smoking gun, the evidence that tells you JPMorgan knows they are trapped to look at their own SEC filings. Every quarter, banks have to file 10Q reports. In Q3 2024, JPMorgan's precious metals derivatives book decreased by $147 billion. At the same time, their physical metal holdings increased by 2,100 tons. Think about that. The bank that held the largest short position for 14 years is now simultaneously closing out its paper shorts and hoarding physical metal. This isn't normal portfolio rebalancing. This is institutional panic. They aren't doing this because they suddenly love silver as an investment. They are doing it because they know the paper market is going to fail, and they need physical metal to survive. And if you check their most recent XQ filing, in the risk management section, there is a line buried in the legal disclaimers. It says, basically, that physical delivery demands may exceed available inventory during periods of market stress. That is corporate lawyer speak for we might not be able to deliver what we sold. They are telling you the trap exists right there in the documents they are legally required to publish. They are just betting nobody reads the fine print. They built the trap, they got caught in it, and now they are scrambling to switch sides before everyone else realizes the emperor has no silver. So, here is the question that matters most to you, the one that keeps every trader awake at night. What happens next? How high does silver actually go when this trap fully springs? The answer isn't about guessing or looking at charts. It is pure math. And let me tell you, the math is absolutely brutal for anyone shorting this market. Let's look at the inventory numbers, because this is where the fantasy of the paper market collides with the reality of physical metal. As of December 2024, if you look at the total COMEX registered silver, that is the metal that is actually allocated, sitting in a vault and ready to be delivered right now. It stands at roughly 28.4 million ounces. Now wait, you have to compare that to the other side of the ledger. Look at the open interest. That is the total number of paper contracts outstanding. Right now, that number represents 862 million ounces of paper claims. That is 862 million ounces that people have a legal right to demand from the exchange. Do the math with me. We have roughly 28 million ounces available to deliver against 862 million ounces of promises. That is a ratio of roughly 30-1. Imagine a game of musical chairs where you have 30 people circling, but there is only one single chair. That is the silver market right now. It's 30 paper claims for every single physical ounce actually sitting in deliverable form. Now, remember what I said earlier? Historically, about 95% of these contracts usually settle in cash. That has been the saving grace of the system. But let's run a calculation based on what is happening today. What happens if that behavior changes just a tiny bit? What happens if just 3.5% of open interest demands physical delivery instead of the historical 5% weight? The historical delivery demand is even lower, usually less than 1%. But let's say 3.5% want the metal. 3.5% of 862 million is 30.2 million ounces. Available registered inventory is around 28.4 million ounces. Well, look at that. The numbers are incredibly tight. In fact, we are already in deficit territory. If just 3.5% of the people holding these contracts decide they want the real thing, the system has zero buffer left. It breaks immediately. And you have to remember, in December alone, JPMorgan got notices for 52 million ounces. That wasn't a projection. That happened. If that rate continues, and remember, this is the first month silver held above $59, then the entire registered inventory gets depleted in about 5.4 months. We are looking at May 2025 as the mathematical endpoint where the deliverable silver simply runs out. But here's the thing that makes this even scarier. Delivery demands don't happen in a straight line. They accelerate as inventory drops. It's exactly like a bank run. Once people realize the vault is getting empty, they don't wait politely in line. The rational response is to panic and get your metal out immediately before the guy behind you takes it. If delivery rates jump to just 7 million ounces per month, which honestly is totally reasonable once panic sets in, you aren't looking at May anymore. You are looking at an endpoint in March or April 2025. That is 3 or 4 months from right now. And please, don't think new supply can come in and save them. You might think, oh, the miners will just dig more. It doesn't work like that. Industrial demand for 2025 is projected at 642 million ounces. We are talking about solar panel manufacturers who are expanding globally. Solar panels alone need 247 million ounces for next year's production. That is a 49 million ounce increase just from the solar sector. Then you have electric vehicles. Every EV uses about 25 to 50 grams of silver, with 17 million EVs projected for 2025. That is another 15 to 25 million ounces of new demand that simply did unexist a few years ago. Look at the total picture. Global mine supply is about 843 million ounces. So if industrial demand eats up 642 million and total supply is 843 million, that leaves a surplus of roughly 201 million ounces for everything else: coins, bars, investment, jewelry. That surplus used to be 340 million ounces back in 2020. It is shrinking every single year. The cushion is gone, and the final nail in the coffin. Since industrial users are now panic buying directly from the miners to secure their supply chains, that metal isn't even making it to the COMEX warehouses. The exchange is being bypassed, so the supply can't save them. The inventory math is terminal. The endgame is inevitable. The only question left is how high silver goes when everyone else figures out what the math has been screaming for months. Because at $59, we aren't at the end. You're just getting started. So how high does it go? We can look at the Volkswagen short squeeze in 2008 for a pattern. That happened in 3 stages. Stage 1 was a gradual rise. Stage 2 was a pause. Stage 3 was a vertical spike of 380% in 48 hours. Silver has already done stage 1, from the 2020 low of $18 to the current $59. That is a 327% gain. We are entering stage 2 right now. The forced deliveries in December are the attempt to cover before it explodes. Stage 3 triggers when registered inventory drops below 10 million ounces. That is the point of no return. Here are the scenarios based on the math. Scenario 1, conservative. $120 to $150 per ounce. This assumes the gold to silver ratio goes back to its historical average of 40 to 1. Scenario 2, moderate. $200 to $250 per ounce. This matches the 1980 peak adjusted for inflation. Scenario 3, vertical spike, $295 to $350 per ounce. This is what happens if industrial supply chains panic. Imagine you are a manager at a solar company. If you need silver to keep the factory open, $300 an ounce is cheap compared to shutting down. When industry competes with investors and there is no metal, prices don't rise linearly, they go vertical. The timeline for this unraveling is becoming clearer by the day. Based on the current burn rate of registered inventory, we are looking at a critical convergence point in the second or third quarter of 2025. That puts us roughly 6 to 9 months away from a potential market dislocation that could rewrite the history books. Now, I want to be extremely clear about my intentions here. I am not a financial advisor, and I am certainly not giving you personalized investment advice. I am simply an analyst showing you the raw arithmetic. This isn't a prediction based on feelings. This is a calculation based on public data occurring in real time. We are watching a slow-motion collision between paper promises and physical reality. For 14 years, JPMorgan engineered a brilliant scheme. They built a paper trap that relied on the assumption that investors would always settle for cash rather than metal. It was a perfect profit machine, as long as the music kept playing. But the introduction of Basel III banking regulations, combined with silver crossing the critical threshold of $59 per ounce, has shattered that mechanism. The trap they built for others has now snapped shut on them. They are currently in a position where they are being forced to deliver metal they simply do not have in reserve. The leverage in the system has become dangerous. Right now, the ratio stands at approximately 30 paper claims for every single ounce of physical silver sitting in a deliverable vault. Think about the fragility of that structure. Historically, the system survives because only a tiny fraction of people ask for their metal. But today, the math suggests that if just 3.5% of contract holders stand for delivery, a tiny increase from the normit creates a deficit that breaks the exchange. At the current rate of inventory depletion, the mathematical breaking point arrives in just 3 to 5 months. The endgame is no longer a question of if, but when. The only variable left to solve for is price. How high does silver go when the broader market realizes what the supply data has been screaming for months? When the panic buying starts, price discovery will happen very quickly. Because at $59, we aren't seeing the end of this story. We are just witnessing the opening chapter.